studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
One of the first questions new tax preparers ask when dealing with corporate investment income is, what is the correct way to enter investment income transactions into the accounting records? The answer may be surprising. In practice, there is often more than one acceptable method. As long as the accounting records are accurate, the financial statements are reliable, and the T2 return is prepared correctly, different approaches can be used. The first method shown on the left is the working paper approach. With this approach, the accountant begins by reviewing detailed investment information. This may include brokerage statements, monthly investment statements, realized gain and loss reports, dividend reports, and interest summaries. Rather than recording information directly from tax slips, the accountant analyzes all of the investment activity and prepares detailed working papers. These working papers summarize the investment income and become the basis for the journal entries. The journal entries then flow into the financial statements and ultimately into the T2 corporate tax return. This approach provides a high level of detail and is often preferred when investment portfolios are large or complex. On the right side, we see the T-slip entry approach. This method is much simpler. Instead of analyzing every transaction, the accountant primarily relies on T3 and T5 slips as the source documents. The information from the slips is recorded directly into the accounting records through journal entries. Those journal entries then flow into the financial statements and ultimately into the T2 return. This approach is often used by smaller corporations with less complex investment activity. Notice the balance scale in the center of the slide. This represents one of the most important lessons in corporate accounting. Neither method is inherently better than the other. Both methods can produce accurate financial statements. Both methods can produce accurate T2 returns. The difference lies in the amount of detail, analysis, time, and effort involved. The working paper approach starts with detailed transaction analysis. The T-slip entry approach starts with tax slips. But both paths ultimately lead to the same objective: accurate accounting records and accurate tax reporting. The key takeaway from this slide is simple. There is no single correct method for recording investment income. The goal is not to use the most complicated process. The goal is to choose the method that best fits the circumstances, while still producing accurate financial statements and an accurate T2 corporate tax return. Now that we understand the two accepted approaches for recording investment income, the next question is, which approach is better? The answer depends on the circumstances. Both methods can produce accurate financial statements and an accurate T2 return when used properly. The real difference lies in the level of detail, the amount of work involved, and the complexity of the investment portfolio. Let's start with the working paper approach shown on the left. This method begins with a detailed analysis of investment activity. The accountant reviews brokerage statements, realized gain reports, dividend reports, transaction summaries, and interest reports. From this information, detailed working papers are prepared before any journal entries are recorded. One of the biggest advantages of this approach is accuracy. Because every transaction is analyzed, there is a stronger understanding of what occurred during the year. It also provides excellent support if questions arise from management, auditors, or the CRA. The audit trail is stronger, capital gains are easier to track, and complex investment portfolios can be analyzed more effectively. However, these benefits come at a cost. Preparing detailed working papers requires more time, more effort, and usually results in higher accounting fees. For smaller corporations with simple investment portfolios, this level of analysis may be more than what is actually needed. Now let's look at the T-slip entry approach shown on the right. This method is designed to be simpler and more efficient. Instead of analyzing every transaction, the accountant primarily relies on T3 and T5 slips as the source documents. The information from those slips is recorded directly into the accounting records and then flows into the financial statements and tax return. The advantages are clear. The process is faster, less expensive, and easier to implement. For many small owner-managed corporations with relatively simple investment activity, this approach is practical and cost-effective. However, there are trade-offs. Because the slips provide summary information rather than transaction-level detail, there is less supporting documentation available. The audit trail is weaker, and challenges can arise when dealing with fiscal year differences or when T3 slips are received several months after year-end. The comparison table at the bottom summarizes the trade-offs. The working paper approach offers greater detail, stronger support, and is generally preferred for larger and more complex portfolios. The T-slip entry approach is faster, less costly, and often ideal for smaller portfolios. But notice the trophy in the center of the slide. It highlights the most important lesson. The objective is not to prove that one method is superior. The objective is to produce accurate financial statements and an accurate T2 return. The key takeaway from this slide is, accuracy matters more than the method. A good accountant chooses the approach that provides reliable results while remaining practical, efficient, and appropriate for the client's specific circumstances. At this point, we understand the two accepted methods for recording investment income. We know the working paper approach provides greater detail and stronger support. We know the T-slip entry approach is faster and more efficient. So the next question is, how do you decide which approach to use? The answer is professional judgment. There is no universal rule that says every corporation must use one method or the other. Instead, accountants evaluate the facts and circumstances of each client. The first factor to consider is portfolio size. For a small owner-managed corporation with a modest investment portfolio and relatively simple investment income, the T-slip entry approach is often the most practical choice. The investment activity is limited, the reporting requirements are straightforward, and the cost of preparing detailed working papers may not be justified. In situations like these, using T3 and T5 slips as the primary source of information can be both efficient and cost-effective. On the other hand, consider an investment holding company with a large portfolio, significant investment income, and numerous transactions throughout the year. In that environment, the working paper approach often becomes the preferred choice. The larger the portfolio, the greater the need for detailed tracking, transaction analysis, capital gain calculations, and supporting documentation. The second factor is complexity. Even a relatively small portfolio can become complicated if it contains mutual funds, foreign investments, capital gains, return of capital adjustments, or frequent trading activity. As complexity increases, detailed working papers become increasingly valuable. The third factor is client expectations and budget. Some clients prioritize lower compliance costs and are comfortable with a simpler reporting process. Others are willing to invest additional time and accounting fees in exchange for stronger documentation, greater transparency, and more detailed analysis. And then there is the approach that many experienced practitioners actually use in real life, the hybrid approach. Instead of choosing one method exclusively, they combine both methods. For example, they may enter straightforward T5 interest income directly from the tax slip. They may enter dividend income from a T3 slip, but for capital gains, foreign investments, or more complicated transactions, they prepare detailed working papers. This combination often provides the best balance between efficiency and accuracy. That is why many professional firms do not strictly follow a single method. They adapt their approach based on the nature of the investment activity. The most important lesson from this slide is that the objective is not to use the most complicated method. The objective is not to create the largest working paper file. And the objective is certainly not to impress the client with complexity. The real objective is much simpler. Prepare accurate financial statements. Prepare an accurate T2 return. And do so at a reasonable cost to the client. When those three goals are achieved, the right approach has been chosen.